$500,000. In 2026, that number is everywhere in real estate conversations, and most people hearing it have absolutely no idea what it actually means for their monthly bank account. So here's the real question. Who can genuinely afford a $500,000 home right now? And does that person sound anything like you? Because the answer might completely change how you think about your next move. Let's talk about what a $500,000 home actually costs you every single month, and I promise this number is going to hit differently than you expect. With a 20% down payment, you're financing $400,000. At today's mortgage rates hovering around 7%, your principal and interest payment lands at roughly $2,661 per month. But here's what most people forget entirely. That is not your housing payment. That is just where your housing payment starts. Stack on property taxes averaging around $458 per month nationally. Homeowners insurance at roughly $150 per month conservatively, and suddenly you're sitting at about $3,270 every single month before you've paid a single utility bill or dealt with a single leaky faucet. And if you're in an HOA community, add anywhere from $200 to $800 more on top of that. So now that you know the real monthly number, the obvious next question becomes, what income do you actually need to pull this off? Lenders use something called the 2836 rule, which says your housing costs shouldn't exceed 28% of your gross monthly income. Plug in that $3,270 payment and work the math backwards, and you land at needing roughly $140,000 per year in gross household income just to satisfy that benchmark. Not take-home pay, gross income before taxes take their share. And here's the part that stings. The median American household earns around $80,000 per year. At that income level, the $3,270 monthly payment would consume over 56% of everything coming in after taxes. Lenders won't approve that scenario, and honestly, surviving it would be nearly impossible. But income is only half of this equation, because where does $100,000 for a down payment even come from in the first place? This is the part of the conversation that makes most people deeply uncomfortable. The average American household saves approximately 4.5% of their income each year. At $100,000 annually, that's $4,500 saved per year, meaning accumulating $100,000 takes about 22 years. And that's assuming home prices politely waited for you to catch up. They absolutely will not. There are faster paths, though. FHA loans allow down payments as low as 3.5%, meaning around $17,500 on a $500,000 purchase. VA loans for eligible veterans require zero down payment and zero PMI, which is genuinely one of the most powerful and underused financial tools available today. Down payment assistance programs also exist at the state and local level, and a free appointment with a HUD-approved housing counselor can tell you exactly what's available in your specific area. But even after you solve the down payment puzzle, there's another number that will either save you or cost you a stunning amount of money. Your credit score. The difference between a 620 score and a 760 score on a $400,000 mortgage isn't minor. It's roughly 1.5 percentage points in interest rate. At 6%, your monthly payment is $2,398, and you pay about $463,000 in total interest over 30 years. At 7.5%, your payment jumps to $2,797, and your total interest balloons to around $607,000. Same house, same loan, same 30 years, but a $144,000 difference in lifetime cost determined almost entirely by 3 digits. Spending 12 to 18 months actively improving your credit score before buying could be the highest return financial move available to you. But even a perfect credit score won't save you if your debt-to-income ratio is out of control. You could earn $150,000 per year and still get denied for a mortgage, and it happens more than people realize. Lenders look at your total debt-to-income ratio, everything you owe monthly divided by your gross monthly income, a car payment of $650, student loans of $800, and a $200 credit card minimum means $1,650 in existing obligations before the mortgage enters the picture. Add the housing payment, and you're approaching the 43% to 45% ceiling most lenders enforce. Eliminating a $650 car payment before applying can increase your qualifying loan amount by $100,000 or more. Most buyers get the sequencing completely backwards, saving aggressively for a down payment while carrying high monthly debts that shrink their qualification. Clear the debts first, then build the down payment. The math almost always favors that order. And speaking of math that most buyers never think to calculate, where you buy matters as much as what you buy. The same $500,000 budget produces wildly different lives depending on geography. In Cleveland, Ohio, it buys a 4-bedroom renovated Victorian above the median. In Austin, it buys you something fairly average. In San Jose, California, $500,000 is a down payment on a median home, not the home itself. Property taxes alone swing dramatically, from 2.2% annually in New Jersey to just 0.3% in Hawaii. On a $500,000 property, that's the difference between $11,000 per year and $1,500 per year in taxes alone. State income tax further reshapes what your paycheck actually looks like every 2 weeks. The buyers who navigate this successfully analyze the total cost of the state and city just as carefully as they analyze the house itself. So here's the honest profile of someone genuinely ready for this purchase in 2026. Household income above $130,000 with stability and documentation. Existing monthly debt obligations under $500 total. Credit score at 720 or above. Between $90,000 and $110,000 available for down payment and closing costs combined. And critically, an emergency fund still intact after closing because a house with no financial cushion turns every broken appliance into a debt spiral. That profile represents roughly the top 20% of American earners. If you're close but not quite there, the answer isn't to give up. The answer is that you're not ready yet, and knowing that clearly is enormously valuable. The buyers who walk into a $500,000 purchase with clear eyes, sequenced debt elimination, optimized credit, and full reserves are the ones who own that home comfortably in 15 years without regret. The buyers who stretch because a lender handed them an approval letter discover around month 8 what the real number feels like when life doesn't cooperate. Know exactly what you're walking into before you sign anything, because the math doesn't care about your optimism. It only cares about your numbers.